Imagine this. You take 500 bucks and in just 3 months it turns into $1,000,000. Sounds insane, right? Well, that is the promise of cryptocurrency. But what's the catch? Today, we're going to pull back the curtain on this high-stakes world, a place where fortunes are made and, yeah, lost in the blink of an eye.
I mean, just listen to this quote. It comes from a crypto entrepreneur, and it just perfectly captures the crazy allure of Web3. The idea that the downside, the worst-case scenario, is retiring for life in 5 years? Wow, that's the kind of thinking that's driving this whole crypto gold rush. But you gotta ask, is it just too good to be true? Well, let's find out.
And look, this isn't just talk. We are seeing some absolutely jaw-dropping numbers. Get this. A 25-year-old founder, Krishna Mohan, his Web3 gaming company reportedly pulled in around 200 crores in revenue last year. That's over $20 million. I mean, that's more than some established companies make in an entire decade. It's wild.
So, the big questions are, how is this even possible? And maybe more importantly, what are they not telling you? In this explainer, we're going to dive deep. We're going to get into the secrets that the so-called gurus on social media might not want you to know.
All right, so to answer those questions, we first have to understand the dream, right? The promise that's being sold. So let's kick things off with Section 1, the billion-dollar promise, and really explore what has so many people so excited about Web3.
Okay, so one of the big methods you hear about for getting started is something called airdrop farming. The whole idea is actually pretty simple. You've got these new crypto projects, and to build a community and get some buzz, they just give away free tokens. To get in on it, all you really need is a social media account, like on Twitter, and a Web3 wallet, which is basically just a digital account for your crypto. And the claim? The claim is that you can earn thousands of dollars a month just by interacting with these new projects. Sounds easy, right?
And the success stories you hear are just staggering. You hear about copy trading, where you can literally set your account to automatically mimic the moves of a pro trader. They say you can turn 500 bucks into $3,000 in just 3 days. Then you've got the story of the kid who supposedly started with nothing but a phone and made $1,000,000 in 3 months from airdrop farming. I mean, come on. You have to wonder, are these stories the exception or are they the rule?
Okay, to really get how these insane returns are even possible, we need to peek under the hood at the tech that powers it all. So let's jump into our next section, Welcome to Web3, where we're going to try and decode the technology behind all this hype.
So at the very heart of all this is a concept called Web3. Think about it like this. Web 1, that was the early internet, right? You could basically just read stuff. Web 2 is what we have now. You create all this amazing content for huge platforms like Instagram and YouTube. But Web 3 is supposed to be the next big step, ownership. It's this vision of an internet where you control your own data, and you get paid for your time and attention, not the big tech giants. And the magic piece of tech that makes all this possible? It's the blockchain. The easiest way to think of it is like a shared digital receipt book. But the cool part is, it's not controlled by any single bank or company. Every time a transaction happens, a whole network of computers verifies it, puts it into a block, and then cryptographically changes it to the last one. What you end up with is a super secure, transparent, and permanent record that's almost impossible to mess with. Okay, now this is where things get really interesting, because you can see the huge difference between the old world of finance and this new one. On one hand, you have traditional money, right? It's centralized, it's stable, but sending it across borders, so slow. Then you have crypto. It's decentralized, it's lightning fast, but it is also incredibly volatile. And that, right there, is the fundamental trade-off every single crypto investor has to make. You're basically swapping stability for speed and control.
And that volatility, that's exactly where the shiny dream of crypto smacks right into a very harsh reality. So for this next section, we're entering what I'm calling the trader's gauntlet. This is the other side of the coin, the dark side of crypto, where fortunes aren't just made, they are absolutely destroyed in the blink of an eye.
So, let's be real. If you can make thousands of dollars just by clicking a few buttons, there's a question that should be screaming in your head right now. What's the catch? The answer? Well, it might just surprise you. Okay, here it is. The brutal, honest truth. More than 90% of new crypto traders lose money. Let that sink in. For every single one of those amazing success stories you hear online, there are at least 9 others that end in total heartbreak. So why? Why is this happening?
Well, the crucial part is understanding the common traps that people fall into, and the reasons are surprisingly common.
First, you've got emotional trading, buying into the hype, that fear of missing out or FOMO, and then panic selling the second things dip. Then there's just having no clear strategy, basically just gambling, investing way more than you can actually afford to lose, chasing after coins that are being artificially pumped up. And the big one, misusing leverage. That's a tool that can amplify your gains, sure, but it can also amplify your losses into oblivion.
And this timeline right here shows you just how fast it can all fall apart. Let's walk through this cautionary tale. Day 1. A trader puts in 50,000 rupees, feeling great. By day 5, the market dips 25% and they panic. They sell, locking in a big loss. Now they're frustrated, so they try revenge trading to win it all back, using 10x leverage. But here's the killer part. With that much leverage, a tiny 5% drop against you is enough to wipe out your entire account. And just like that, from 50,000 rupees to zero, in less than 3 weeks.
The technical term for what just happened in that story is liquidation. You can think of it like a margin call in the stock market, but way faster and way more brutal. When you're trading with borrowed money, that's leverage, the exchange sets a price where your losses are just too big. If the market even touches that price for a split second, poof, your position is automatically closed and your initial money is gone. For good.
So after hearing that, the question is, how do you avoid becoming another one of those cautionary tales? Well, that's what this next section is all about. We're going to explore the long-term playbook, the strategies that experienced traders use to navigate all this volatility and actually protect their money.
Okay, one of the single most powerful strategies for managing all this risk is called dollar cost averaging, or DCA for short. Now, instead of trying to be a genius and time the market perfectly, dumping all your money in at once, you just invest a fixed amount on a regular schedule, say $100 every single month. The beauty of this is it takes all the emotion out of investing and helps you smooth out those wild, crazy price swings.
And hey, don't just take my word for it. The data really speaks for itself. Just look at this comparison over a 2-year period that had a major market crash. An investor who went all in at the very top and just held on, the hodler or hold on for dear life strategy, they would have been down over 50%. Ouch. But look at the investor who used DCA. They just bought a little bit each month right through the crash, and they basically broke even. That's a massive difference. It just shows you the power of having a disciplined approach.
At the end of the day, discipline is the name of the game. It means you need a clear plan before you invest a single dollar. You need to know your entry price, your take-profit price, and maybe most importantly, your stop-loss price to cut your losses. A good rule of thumb is to aim for a risk-to-reward ratio of at least 1 to 2. So for every dollar you risk, you're aiming to make 2. And here's a key pro tip. Once you've made a nice profit, take your initial investment out. Get it off the table. That way you're only playing with the house's money.
So where does crypto actually fit into a normal, balanced portfolio? Well, most financial experts are pretty clear on this. Because its value is based mostly on speculation, not tangible assets, you have to treat crypto as a very high-risk asset. Honestly, think of it almost like a lottery ticket. For beginners, that means it should be a tiny slice of your total investments. We're talking way less than 10%. Anything more than that, and you're not really investing. You're just gambling.
And this quote right here, it just perfectly captures the huge mindset shift you need to make. This is not about getting rich quick. It's about staying in the game long enough to succeed. The truly successful traders, they aren't focused on hitting moonshots. No, they focus on preserving their capital first and then growing it second. That right there is the key to long-term success in this crazy, volatile market. So after all that, what's the big takeaway here? I think it's that the crypto world is just a land of incredible contrasts. The stories of life-changing wealth, they're real. The technology, it's generally groundbreaking. But the risks are just as real, and the road to success is paved with the digital ghosts of people who gambled and lost. The promise is absolutely massive, but it demands an equal amount of discipline, of caution, and yeah, a very, very healthy dose of skepticism.
Which brings us right to our final big question. Is crypto a ticket to real financial freedom, or is it just the world's largest, most volatile digital casino? The answer, it seems, really depends entirely on you, on how you approach it. Are you a gambler or are you an investor? The choice is yours.